Welcome back to our channel. In our previous videos, we have discussed what transfer pricing is and delved into the components of the Income Tax Transfer Pricing Regulation 2018. We define transfer pricing as the setting of prices for transactions between related parties, such as subsidiaries of the same multinational company, to allocate profits between different tax jurisdictions. In today's video, we will be giving a better overview of the Income Tax Transfer Pricing Regulations 2018. We will explore exactly what these regulations entail by highlighting their objectives, significance, and the role in shaping Nigeria's tax landscape. Whether you are a multinational enterprise, a tax professional, or simply curious about how global tax practices affect local economies, this video is for you. So buckle up. Hi, my name is Olatunji Abdulrazak. I am the founder and CEO of TaxMobile.online. Welcome to my YouTube channel, A Stitch in Tax Saves Cash. This channel is dedicated to helping you stay on top of your taxes. We will provide you with tips and strategies to help you keep more money in your pockets and minimize your tax liability while you stay in compliance with tax laws. So, if you want to start taking control of your finances from today, hit the subscribe button below and click the notification bells to stay updated on our latest videos. Let us start with an overview of the Income Tax Transfer Pricing Regulations 2018. The Federal Inland Revenue Service introduced the Income Tax Transfer Pricing Regulation 2018, effective for financial years starting after March 12, 2018. These regulations replace the previous 2012 regulations and incorporate significant updates from the OECD Transfer Pricing Guidelines and the African Tax Administration Forum suggested approach to drafting TP legislation. The Organization for Economic Cooperation and Development, OECD, has developed guidelines on transfer pricing to assist multinational enterprises and tax administrators in the evaluation of TP transactions and provide an element of consistency among countries in the application of such rules. Since their first release in 1995, these guidelines have been periodically revised, with the latest edition in 2022 offering new insights on selecting the most appropriate transfer pricing methods and addressing transfer pricing aspects of business restructuring. OECD member countries adopt these international taxation principles as it serves the dual objective of securing the appropriate tax base for each jurisdiction and avoiding double taxation, thereby minimizing conflicts between tax administrations and promoting international trade and investment. Moreover, in our interconnected economy, coordinated international tax standards are more effective at achieving this objective than competitive national tax policies. The OECD mission is to contribute to the expansion of world trade on a multilateral, non-discriminatory basis and to achieve the highest sustainable economic growth in member countries. This mission drives the continuous efforts to build a consensus on international taxation principles, thereby avoiding unilateral responses to multilateral problems. Transfer pricing significantly impacts both taxpayers and tax administrations as it largely determines the income, expenses, and taxable profits of associated enterprise in different tax jurisdictions. Tax administrations are encouraged to take into account the taxpayer's commercial judgment about the application of the arm's length principle in their examination practices and to undertake the analysis of transfer pricing from that perspective. In seeking to achieve the balance between the interests of taxpayers and tax administration in a way that is fair to all parties, it is necessary to consider all aspects of the system that are relevant in a transfer pricing case. One such aspect is the allocation of the burden of proof. In addition to the transfer pricing regulations, FIRS also issued the Income Tax Country-by-Country Reporting Regulation 2018 in exercise of powers conferred on it by Section 61 of the Federal Inland Revenue Service Establishment Act and all other powers enabling it. As a member of the Inclusive Framework, a group of jurisdictions committed to the implementation of the minimum standard of the BEPS-related measures, Nigeria signed the Multilateral Competent Authority Agreement on Country-by-Country Reporting in January 2016 and has produced the Income Tax Country-by-Country Reporting Regulations 2018 for the implementation of the country-by-country reporting in Nigeria. The CBCR regulations take effect from 1st January 2018 and form part of the enhanced tax disclosure requirements set out by Action 13 of the Base Erosion and Profit Shifting (BEPS) project. The regulations aim at providing tax authorities with improved information to enable them better assess international tax avoidance risk. Now, under the legal framework for the income tax transfer pricing regulations, let's read through the purpose, objective, and scope of application. Purpose. These regulations give effect to the provisions of Personal Income Tax Act as amended, Company Income Tax Act as amended, Petroleum Profit Tax Act as amended, Capital Gain Tax Act, and Value Added Tax Act as amended. Objective. The objective of these regulations are to ensure that Nigeria is able to tax on an appropriate taxable basis corresponding to the economic activities deployed by taxable persons in Nigeria, including in their transaction and dealings with related persons. Provide the Nigerian authorities with the tools to fight tax evasion that may arise through over or underpricing of transactions between related persons. Reduce the risk of economic double taxation, provide a level playing field for both multinational enterprises and independent enterprises carrying on business in Nigeria, and provide taxable persons with certainty of transfer pricing treatment in Nigeria. Scope. These regulations shall apply to transactions between connected persons and shall include sale and purchase of goods and services, sales, purchase or lease of tangible assets, transfer, purchase, license or use of intangible assets, provision of services, lending or borrowing of money, manufacturing arrangements, and any transaction which may affect profit or loss or any other material incidental to, connected with, or pertaining to the transactions referred to in paragraphs A to F of this regulation. For purposes of applying these regulations, a permanent establishment and its head office are treated as separate entities who are connected persons, and any transactions or dealing between a permanent establishment and its head office or other connected persons shall be considered to be a controlled transactions. And there you have it, a detailed overview of the Income Tax Transfer Pricing Regulations 2018. Thank you for joining us on this enlightening journey. If you have any questions or want to share your thoughts, feel free to drop them in the comments below. And if you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more insightful content. Also remember to watch our previous videos.